Billionaire investor, trader, and hedge fund manager Paul Tudor Jones said today on his Bloomberg interview that gold is his favorite trade for the next 12 to 24 months, and that he thinks that once gold gets to $1,400 an ounce, it can quickly go to $1,700. So he laid out the macro case for why he likes gold so much. He talked about central bank intervention. He talked about the Federal Reserve doing reverse course, doing a 180, stopping QT soon, and going to rate cuts, and how bond yields globally are negative. They're non-yielding due to financial repression and negative interest rate policy. So he said basically that all of these things are now tailwinds for gold. So despite paper price manipulation, it looks like more people, more fundamental driven people are starting to go into the gold market. This echoes what billionaire Sam Zell said in January. I went back and looked up the date for you guys. It was in the first 10 days of January that Sam Zell said it. He was a real estate billionaire, and Sam Zell said he had never bought an ounce of gold in his life before, and that he was buying physical gold and gold miners. So things have started to change in the last 8 to 12 months in the gold market. On top of this, you have a lot of central bank buying. That's nothing new, but it is increasing. There's been stories out in the last couple days that the People's Bank of China has been increasing its buying of physical gold. The story from Zero Hedge was that China increased, adding 16 tons of physical gold, the biggest monthly increase since January 2016, but they've been buying pretty much every month for a while now. So all these things together, the sentiment, it looks like now for Wall Street, is changing. A lot of these big billionaire hedge fund guys that maybe in the past would not have gone into gold, or they would have only done it for a very short amount of time, it seems that they're starting to go into gold. I would not be surprised if Stanley Druckenmiller, in addition to his long treasuries position, also announces a big gold hedge as well. And Paul Tudor Jones, if you're not familiar, he's been criticizing heavily for the last 12 to 18 months the U.S. corporate bond market. He is really, really worried about the corporate bond market blowing up. So he is going to very defensive measures. It looks like Paul Tudor Jones, in addition to his gold position, and I'll attach a link to the interview. It's a very short, that segment at least is only about 2 minutes on Bloomberg. There's a longer, in-depth part where he talks about his macro analysis. But it looks like he's also long treasuries. So he's doing kind of the barbell strategy where you have cash, you have treasuries, and you have gold. So that seems to be the new paradigm shift for a lot of these hedge fund guys on Wall Street. So they in a interest rate environment, in a macro environment where the global central banks are taking away interest rates, it makes holding gold more attractive because you're not getting paid lots of interest to hold bonds, especially government debt. Because government debt, they want it inflated away. Remember what they did during the 2008 financial crisis. A lot of the problems in the private sector and with the banks, the governments inherited these problems. They moved a lot of this garbage onto their balance sheets. So the taxpayer and the saver in those digital debt-based fiat currencies are going to be the ones who are going to pay for all this stuff long term. We just got new news out of China that there's been really bad food price increases in the last 12 months. It's almost 8% in a single year. Really crazy, huh? So the gold market, this is going to be a short show. Just wanted to bring you guys that current event. The show's not over yet. I got a few more things I wanted to talk about, and I'll attach links to some of these stories as well. But be very, very careful buying individual mining stocks. Okay, we're at a gold price right now at $1,332.90 and a silver price which is not catching up at $14.75. So the gold market, more money is going into gold clearly with price action than is going into silver. The silver market is not doing nearly as well as the gold market, unfortunately. And this is a very, very difficult market for gold miners, primary gold miners, and primary silver miners. Not all of them are in bad shape, but some of them are in really, really bad shape. And hopefully you guys, if you want to learn more about the mining industry, definitely go back and listen to my Hecla Mining case study. And there was new stories, new current events for Hecla Mining. They just announced in the last week or so that they had to shut down one of their smaller mines and that they're cutting back expenses at a lot of their other mines. And their CEO is now claiming that they're going to live within their means of their operating cash flow. Well, how do you live within your means of your operating cash flow when you have so much debt? How do you live within your means of your operating cash flow when all of your mines, which are not, by the way, generating free cash flow, when those mines, a lot of them need upgrades? So to me, this probably means Hecla is either already preparing for bankruptcy in the near future, or they're going to sell a lot of shares, or they're going to have to start doing what Yamana Gold did with Chapada, which was supposedly Yamana Gold's best asset. Chapada was Yamana Gold's best margin, best producing, most economic copper and gold mine. And Yamana Gold Management for the last couple of years was saying how this was a cornerstone of our company, where it's generating the best margins for us, the best free cash flow, it has great exploration upside. And then they turned around, did a total 180 to shareholders, and they sold the asset for $1 billion to Lundin Mining. And so now Lundin Mining, and that was because Yamana Gold could not make the approximately $230 million capex investments into the Chapada mine to optimize the mine further, to increase things at the mill, to cut costs, to improve recoveries on copper and gold that had to be made. And this is something, if you're not familiar with the owning individual mining stocks, you're not familiar with mining in general, you're going to be caught off guard with some of these companies. Not all of them, but some of these companies, some of these individual mining companies. And we've been in a bear market now for the last almost 8 years in gold and silver, especially for the mining shares. And the mining companies have cut costs to the bone at the mine. So all-in sustaining costs, they've cut the costs they can cut. And they're at a stage now at the mine where the only way for a lot of these miners to cut any more costs, besides in the selling, general, and administrative expenses column, which is management, not at the mine, the only way some of these miners can cut costs anymore at the mine is to make very, very big capex or capital expenditure investments into the mine. So some of these miners have delayed making necessary or advantageous capex upgrades to these mines for the last 5 to 7 years. They've held off. They're hoping gold would go higher. They were hoping silver would go higher. They were hoping gold would go higher. They were hoping silver would go higher. And guess what? It didn't happen. And there's dozens of things that can go wrong at the mine. There's so many moving parts. You can put in robotics. You can put more mechanical equipment. You can do some things to cut costs, but there's only so many costs you can cut in an environment where metals prices are either falling or flat, and oil prices, up until the last month or so, oil prices were rising. And that's really hurting margins for the miners. Now, with oil prices going down and gold going up, that should be a little bit of a tailwind now for some of the gold miners. But for Hecla Mining's costs at the acquisitions they did a year ago, they're still not anywhere near the current gold price. So Hecla has a lot of major problems. Probably if the gold price were to go to $1,400, this is hypothetical, not financial advice, just my opinion. If the gold price were to go to $1,400, $1,500, I could see Hecla Mining selling huge tranches of new shares all the way up to try to delay bankruptcy and then do a reverse stock split. And so your shares may go up in Hecla, but you would underperform some of the other gold miners. Now, if gold doesn't go up for a while, you don't want to hold a company with a bad balance sheet. So the average retail investor, unless you have, this is not financial advice, but unless you have like tight stops or stop losses or downside protection with puts, unless you have some type of exit strategy for your shares in case all of a sudden there's basically like a capex bomb, I'll call it a capex bomb, or just really out of nowhere management announces that they have to spend $50, $100, $200 billion on a mine, and guess what? They either don't have the cash, or it's going to blow through almost all their cash, or they have to go raise a bunch of shares and dilute the stock, and the stock's down 10, 20% in 2 days. So this is as someone who's covered the mining industry both for free I did a lot of work as a free analyst and also gotten paid to do it, and written research reports and interviewed a bunch of CEOs and spoken off the record with some of the best mining stock analysts in the world and read tons of research reports and articles. So I have lots of different sources in the mining industry. The average retail investor is just totally unprepared for all these surprises that could come their way in the mining industry. And to give you guys more examples of that, not only do you have the problems with Hecla, and you could see these things with Hecla 12 months ago, 8 to 12 months ago, you could see that acquisition that they overpaid for, that they were going to have some problems. They had cash back then. They took on more debt. You could see if they didn't fix things that they were going to get in trouble. But I'll give you an example of another CapEx surprise. Okay, Endeavor Silver. Normally, Endeavor Silver has a very good reputation. They're a smaller silver miner, primary silver miner. They don't try to do too much. The management team buys old silver mines, they refurbish them, they get cash flow pretty quickly, and they just reinvest as they go, and they ramp up the mine. Like they upgrade the mill. The management team is good at what they do with their business plan. It's different than other silver miners. But guess what? Endeavor Silver just announced that they got hit with an unexpected amount of CapEx. And so they are not going to be profitable. They are not going to be generating free cash flow for at least Q3 of 2019. So I think the shares are a little bit above $1. I could take a look at the share price real quick right now. Let me see if I can pull it up. That's EXK. Just take a look at the share price really quick. Give me a second. Yeah, so the shares are back at $1.82. They were pretty low. They were almost at $1, I think, a month ago. They were really low for a while. But my point is that Endeavor Silver has cut costs to the bone, slashing costs, and in order for them to cut costs further and to generate any free cash flow at the current metals price, they have to make CapEx upgrades. And you know what? I guarantee you the market did not like it. But being an investor or even a swing trader for 6 months or 12 months in an individual mining stock, this is a danger you can run into. That the company all of a sudden has $100 million, $200 million, God forbid even more than that they have to put into the mine to maintain the mine or to improve recoveries at the mine. So First Majestic Silver, it looks like First Majestic Silver is finally through this mess, that they had pretty large problems at a couple of their mines where they could not lower the costs anymore. This started about 18 months ago. And First Majestic Silver, if you go back and look at First Majestic Silver's balance sheet for years now, Keith Neumeyer has always been careful about this. He had always kept around $100 million in cash as emergency, a cushion, a buffer. So he kept that cash, but it was so difficult for all the miners to raise equity to sell new shares. It was a really bad environment to sell new shares. And First Majestic Silver had put off CapEx upgrades. They had to do them to lower the cost further. So their cash position, they actually, because they couldn't raise the shares, they couldn't dilute. So they took their cash position from $100 million and made the upgrades at the Santa Elena mine, which is they have two pretty good margin mines, which is the San Dimas one they bought in acquisition and the Santa Elena one when they bought out Silvercrest. And they took that cash down to around 50 million, a dangerous level from their 100 million level. But it looks like they're not in any trouble anymore. It looks like they've worked through the problems. But for a while, if the construction for the upgrades at the Santa Elena mine and some of their other mines that they had put the capital in weren't on time, weren't on budget, like let's say they had needed to get, hypothetically, another $50 to $100 million, right? Well, they didn't have another 50 to 100 million. So they would have had to sell their shares at a really bad stock price. Their stock price was already down a lot. Or they would have had to take on debt. It was very risky. So this environment right now is very, very dangerous to be doing deals. There is a lot of opportunity. I want to highlight this. There is a ton of opportunity now for smart mining companies, and especially the 5 largest royalty and streaming companies, the precious metals ones, and also the base metal royalty and streaming companies like in Altius Minerals or some of the others. There's opportunities for that too, to go buy quality royalties or streams on like copper or some of these others. But this is a very dangerous environment to do deals that are too large, because if the metals prices don't rally, then some of these miners are not going to be able to sell the shares and their balance sheets are going to get worse. Now, in the short term, we do have lower oil prices. So higher gold plus lower oil prices means, it should mean, hopefully, better margins for the miners. Probably that won't take into effect until the end of Q2, probably Q3 though. Chris says, Jason, I thought this photo of your gold was going to be kept private. Well, Yamana has good assets, but I think Yamana has made problems, and it is very, very clear to me, in my opinion, that the market no longer trusts Yamana management, and the rumors are Yamana Gold is up for sale. So I don't know what type of premium Yamana is going to be able to get to sell the company, but if you want to speculate and bet on a buyout, maybe you'll get lucky. I don't like to make bets like that. I would rather buy, this is hypothetical, I would rather buy at these prices shares of Wheaton Precious Metals, which just had their tax issues done with, and they can go do deals for more free cash flow, and they have dividend. I think they're cheap. Wheaton Precious Metals. I would rather go buy Osisko Gold Royalty, which had a bunch of write-downs on bad deals, but the underlying business with their assets and their cash flow is still fine. And of course, my favorite, which has the most growth, is Sandstorm Gold, which has the Fruta del Norte royalty, which is small but will hopefully run for a very long time and potentially could have a big increase in cash flows in a few years. That should be online in October, as early as October. But the Cerro Moro silver stream is online now for Sandstorm Gold, which is a big, big deal, and also the Arizona royalty in Brazil from Equinox Gold. So Sandstorm Gold's really starting to rip right now. They can do a deal a smaller deal every 2 or 3 quarters, use their revolving credit facility, which is debt, paid off, use their revolving credit facility on another small deal, paid off, and they don't have to swing, to use a baseball analogy, they don't have to swing big for the fence on every single deal now. They already have more growth on a percentage basis than any other royalty and streaming company in their growth pipeline. So they only need to, they don't have to take big swings now, where they could swing and miss or strike out. They only have to go for singles and doubles now to just diversify cash flow on smaller deals. So I think Sandstorm Gold has a really superb strategy. Anyone who's criticizing Nolan Watson at this point for deals that were 7 or 8 years ago is just a hater and a troll and totally full of shit. So the mining industry is, I would expect, to wrap things up here in the short video, the mining industry, I would expect, if gold does go to 1400 or 1450, by the way, there's a lot of overhead resistance on the charts in the 1425 to 1450 level, so that probably will be tough to crack. But if it does crack those 1450 levels pretty quickly, I would expect the miners, especially the silver miners, but the primary gold miners with the worst balance sheets, to start to sell massive amounts of equity. And that will mean that the miners will underperform other miners. Now, again, this is not financial advice, but you can avoid this. If you don't want to deal with the hassle of looking up individual mining companies, you can avoid this by buying royalty and streaming companies or by buying gold mining stock ETFs. So there's like the GDX, the GDXJ, which the GDXJ doesn't really have real juniors in it. It has too many bigger mid-tier miners. You have the SILJ, which is the silver miners ETF. And then that may get a big boost if gold goes to 1500. That thing could rocket because silver is drastically underperformed. And then you have the two Sprott gold mining ETFs. You have the SGDM and let me look up the other one. I think it's SGDJ. Yeah, SGDJ. And you also have, there's a new one from Frank Holmes at US Global Investors. He has a royalty and streaming company, I think, ETF. That's GO, AU. GO, like a monopoly. And then AU, like periodic table of elements for gold. So that's the other gold mining ETF. So there's a handful of these things now. So if you don't want to deal with the hassle of picking out an individual mining stock, and there's a lot that can go wrong with picking out an individual mining stock. I've made up to 600% in the past on individual mining stocks, speculating on them, but it's very, very dangerous if you don't know what you're doing. Even if you know what you're doing, you can mistime things. There could be unexpected risks at the company, like all of a sudden, oh, there's another $200 million in capex. Or, oh, all of a sudden, we have to shut down this mine because there's a strike with the mining union. I brought up how in like South Africa and other places, even though the South African platinum and palladium miners were on the brink of bankruptcy like 4 or 5 years ago, this is before palladium went crazy, but they were on the brink of bankruptcy like 3 to 5 years ago. And you had the mining unions demanding higher workers' wages. Meanwhile, the miners themselves, because the metals prices were not doing anything, they were going down. The miner and the oil price was not going down either. The miners themselves were on the brink of bankruptcy. They had no margin. They had no profits. And you had the miners' unions in these other countries demanding higher wages. Well, you can't pay higher wages when the company's about to go out of business. But the miners' unions were demanding higher wages anyway. And then in South Africa, you have the craziness of the central bankers talking about printing more money and then nationalizing mines. So another danger with an individual mining company is they don't weigh the geopolitical risks properly. And then either they didn't weigh them to begin with before they made the investment, or things changed materially. Look at how bad Tanzania is now in a lot of aspects for investing in mining. So things can change pretty quickly in another country. I don't have a Litecoin wallet, or I don't have a separate one. I need to figure out how to add a plugin on my website for some of these other cryptos. Does anyone know any WordPress plugins I can add? Wendy, I was expecting an email from you. I never got one. So I will try to send you a message later. I should have some time in the next couple days. I don't have any big plans for the weekend because dating here is horrible. Okay, guys, well, that's it for this short video. Just want to give you an update on Paul Tudor Jones. So now we have, in the last, let's see here, 7-8 months, we have Sam Zell, billionaire real estate investor who never bought an ounce of gold before in his life. He is long gold and gold stocks. And now we have Paul Tudor Jones, who is now long gold and thinks gold will be at, once it goes over 1,400, he thinks a move up to 1,700. If you watch his Bloomberg interview, which is 2 minutes on the gold section, will go up to $1,700 an ounce very, very quickly. So the manipulators, the paper price manipulators, the bullion banks, the trading algorithms that manipulate the gold price, they're probably going to try to keep gold below 1,400. But there's a lot of overhead resistance levels in the 1,425 to 1,450 range. And hopefully gold will break through then. But if not, and this is why I like the royalty and streaming companies better, if the gold price doesn't do anything, if it just goes flat, my royalty and streaming company shares, and I own Wheaton Precious Metals and Sandstorm Gold, they will just keep doing deals. They will keep generating free cash flow. Sandstorm Gold makes around $80 million right at the current gold price with their, they have a small amount of selling general administrative expenses. They make around $80 million per year in free cash flow. That is as much free cash flow or more free cash flow than most of the mid-tier primary gold miners right now and some of the senior gold miners. Okay, so to put things in perspective, Sandstorm Gold is far more efficient of a company. They have about 20 employees. They have around $1 billion market cap, and Sandstorm Gold is generating around $80 million per year in free cash flow. That is more free cash flow per year than a gold miner with 450,000 ounces per year of gold production. And that shows you how difficult, how much hard work, how many things that can go wrong for gold mining. So there's some gold miners that are making like 70, 80, 90, $100 million in free cash flow, but it's not easy for them. Far, far easier for a royalty and streaming company, especially once they get to Sandstorm Gold's size or larger. This is where the business model really, really works. Once you get to the size of Sandstorm Gold or larger, they really, really benefit from being that large and having diversified cash flow, and they can make money in any gold price environment, up, down, sideways. They just change the types of deals they do, and you don't have to worry about all of a sudden you wake up when you own individual mining shares and you see that there's a press release from management that they sold an asset that no one was expecting them to sell to raise cash to pay off debt. Or they had to raise an enormous amount of shares, $100 million or more, because they have to fund this capex for a mine. The mine was in trouble. Okay? So I think I've summarized the mining industry pretty well, again, in just the last like 24 minutes or so. And if you have any more questions, you can send me an email. I used to do consulting sessions for these things, educational stuff, but like it's just not worth my time anymore to do that. So everyone have a nice rest of your day, and I will jump back on if there's any more current events or story updates. I'm working on other interviews to book. It looks like as of right now, I have Danielle DiMartino Booth booked for tomorrow, and I'm working on getting Brent Johnson in the next couple days. Okay, bye for now.